term structure and volatility of interest rates. Okay, so we'll follow the curriculum sequence. A lot of this reading builds on what we've done in level 1. So the material should look familiar. We are just getting a little bit deeper than what we did in level 1. Okay, so first of all, when we talk about term structure of interest rates, what comes to mind? In level 1, when we talked about term structure of interest rates, what we were talking about was you look at maturities on the x-axis and interest rates on the y-axis. And what this meant was securities with a short maturity have this interest rate, securities with a longer term maturity have this interest rate. Then the question is, this interest rate, is it yields or is it spot rates? Okay. In level 1, a distinction was not made, things were vague, and even in the real world, when people talk about term structure of interest rates, sometimes they are referring to the yield curve, which shows the yield to maturities on the y-axis and the various maturities on the x-axis. But in level 2, and especially in this reading, when we talk about the term structure of interest rates, it's the relationship between the theoretical yield on zero coupon treasury securities and maturity. What's this this phrase, the yield on zero coupon treasuries? These are spot rates. Okay, so spot rates are essentially the yield on zero coupon bonds. Okay, so essentially the yield on a zero coupon treasury security is called the treasury spot rate. The term structure of interest rate is thus the relationship between treasury spot rates and maturity. The importance of this distinction between the treasury yield curve and the treasury spot rate curve is that the latter is used to value fixed income securities. So all this is coming out of level 1. So essentially what we then mean is, if you talk about the term structure of interest rates, what we mean is something like this. So let's say a 1-year treasury has an interest rate of 6%, a 2-year treasury has an interest rate or a yield of, a 2-year zero coupon treasury has a yield of 7%, then that's what your term structure of interest rates looks like. Okay, now I hope this looks familiar. We are going to jump right in and we are looking at different yield curves. Okay, so what's a yield curve? Actually, the yield curve simply says, okay, for different maturities securities, so let's say a 6-month T-bill has a yield of 10%, a 1-year T-bill has a yield of 11%, a 2-year T-bill has a yield of, a 2-year treasury note has a yield of 13%, and so on. So when you plot the yields against maturity, you get the yield curve. What is this yield curve called? This is a normal yield curve because it is telling us that the yield on longer term securities, treasury securities, is higher than the short term. What is this telling us? This is a flat yield curve which is saying that the yield on short-term securities is the same as the yield on long-term. This is inverted or negatively sloped. It happens, but it's not that common. So negatively sloped or inverted yield curve, and this is a humped yield curve. Okay, now in this segment we are going to get a little deeper into the shifts in the yield curve. What do we mean by a shift? So, for example, this yield curve, it might shift upwards, which means it might have a movement like this. Now, if all the yields, the short-term yields, medium-term yields, long-term yields are all increasing by, say, 50 basis points, that's called a parallel shift in the yield curve. And in level 1, we were mostly concerned about parallel shifts in the yield curve. So if you hear a phrase that interest rates go up by 50 basis points, we were implicitly assuming that all interest rates across all maturities are going up by 50 basis points. So that's a parallel shift. Okay, but now we are going to get a little deeper into the fact that not all yield curve shifts are parallel. We can also have non-parallel shifts, and there are two kinds of non-parallel shifts. One is called a twist and the other is called a butterfly. Okay, so what is a twist? So a twist is something like this, where essentially not only are interest rates changing, but the slope of the yield curve is also changing. So what's happening over here? What's happening to the short-term rates? If this red, let's say, is your initial yield curve, so what's happening to the newer yield curve? What's happening to the slope? Slope is becoming less, the curve is flattening. Why is that happening? Because short-term rates are rising more than long-term rates. So essentially what's happened is this twist essentially that we are seeing here is a combination of a parallel shift and a change in the slope of the yield curve. So this is a twist. Is this also a twist? So both these are twists where essentially the curve of the yield curve the slope of the yield curve has changed. Okay, next is the other kind of non-parallel shift is called a butterfly shift, where essentially what happens is, if that's your initial curve and something like this happens, let's say we go to another shape like this. So not only is there a parallel shift, there are also slope changes and the curvature also changes. So that's a butterfly shift. The most important kind of shift in the yield curve world is a parallel shift. Okay, so we don't need to get into the details of this, but the very brief points that are mentioned over here, you simply need to memorize. So some people did some research, a statistical analysis on what factors explain historical returns on zero coupon treasuries of different maturities. So for example, if you've invested in treasury securities which have a maturity of 1 year, 5 year, 10 years, 20 years, for example. Okay, now what gives you a return when you hold interest rate securities? You get a return if interest rates go down. Okay, now somebody did a study in terms of what are the factors that explain the returns that you get, and the three sorts of factors they looked at were parallel shifts in the yield curve, and then they looked at twists and butterflies. And what they noticed was when interest rates change, the major component that is giving you a return is the parallel shift component. Okay, in fact, the explanatory power, the R squared, if you remember from your quant, for parallel shift is 90%. And do you remember from level 1, what's the measure of the sensitivity of portfolio value to changes in interest rate? It was duration. Duration, if you remember, was basically measuring a parallel shift in the yield curve. So the point is that the most important part of the shift is the parallel shift component that explained 90% of the returns. Then about 8.5% explanation comes from a twist, and very little explanatory power comes from the butterfly shift. Okay, don't need to go into the details of exactly what they did and exactly what this means, but just the core point. So now the assumption that we made in level 1, where we just focused on parallel shifts, was that a bad assumption or a okay assumption? It was okay. Okay, now that we are at a higher level, it makes sense to also look at twists. Okay, butterflies are not that significant. Okay, now constructing the theoretical spot rate curve for treasuries. Do you remember one of your favorite exercises in level 1 was where you were given the yield curve, and from the yield curve you used this wonderful process called bootstrapping to come up with a spot rate curve. Now, it's highly unlikely that you will be asked to do that bootstrapping exercise in level 2, but it's just assumed that now you are smart enough and knowledgeable enough that you know it. Okay, so I don't think you'll be tested on it, but if you jog your memory, how many people actually heard the lecture on bootstrapping? No one? Yeah, actually it's partly my fault. I didn't give you too much time. All right. Okay, so you can listen to it later if you want. But the three methodologies that have been used to derive the theoretical spot rate curve, do you remember briefly what this was all about? You might have a yield curve where you have yield to maturity on the y-axis, maturity on the x-axis, and we use this method called bootstrapping to come up with what? What do we have on the x-axis? Still different maturities, so 1 year, 2 years, 3 years, and what's the y-axis? Spot rates. So essentially we started with a 6-month T-bill, and if for a 6-month T-bill which is zero coupon, is the spot rate and the yield the same? If there is no intermediate cash flow, they are the same. So we use that and then the yield on the 1 year to come up with a 1 year spot. Once we had a 1 year spot, we looked at the yield on the 1.5 year bond to come up with the 1.5 year spot and so on. Okay, so as I mentioned, I don't think you will be asked about the details of how to do that in level 2. But that's one method of going from your yield curve to your spot rate curve. Okay, another method is econometric modeling for all treasury coupons, securities and bills. Don't need to know the details, just need to know that there are other methods for doing this. And the simplest method, do you recall from level 1 that there is something called treasury coupon strips? So you can have zero coupon 1 year bonds or 1 year strips, 2 years, 3 years. Since they are zero coupon, will the yield on those instruments effectively be the spot rate? Yeah, so you can just observe all those yields on the various strips that are zero coupon, and from that you can derive the spot rate curve. Okay, now let's say that you are actually looking at yield curves and using, let's say that there is some issue with using the strips. For example, the liquidity might be very low on those strips. So if the liquidity is low, that might create an issue. So what are the different sorts of data that you can use to construct the spot rate curve? And essentially, there is a long segment in the curriculum, but the bullet points on this page, this slide, if you understand, that's good enough. 4 kinds of data can be used. One is the treasury coupon strips that I have already talked about. What's the advantage of using treasury coupon strips? You don't have to do bootstrapping, all the work's done for you, the spot rates are given. But what's the disadvantage? There might be liquidity premiums or other issues with the rates implied by the spot rates. Okay, there is also a tax disadvantage on these, which might create an issue. Do you remember from level 1 that if you have a 10-year zero coupon strip, are you getting any cash flow over 10 years? You are not getting any cash flow over 10 years, but you are still required to pay taxes on the interest that you accrue every year. Do you understand that? So if you have a 10-year strip which has a par value of 1,000 and year 0 you bought it for 800, let's say in year 1 the value will go up from 800 to 850. Okay, did you get any cash? No, it's zero coupon. But do you need to pay taxes on this gain? Yeah, so that's pretty bad, where you are not getting any cash but you need to pay taxes. So because of this aspect, there might be some issues with the yields. So there are issues with this, so generally these spot rates are not used to come up with your spot rate curve. Okay, the other method that we talked about is to use on-the-run treasury securities. What are these? Yeah, on-the-run are the most liquid instruments, and they are probably the best ones to use. But what's the problem with so the advantage is the pricing is the best, but what's the issue? There will be a huge maturity gap, in the sense for on the run, let's say that you have 6 months and then you might have 1 year and then 5 year, then 10 year. So how, if you have 1 year then 5 year, how do you come up with the 1.5 year spot? So there are these gaps. How can you come up? You can do some, interpolation, extrapolation, etc. Another method is to use on the run and some off the run securities. What are off the run? So the slight lack of liquidity is an attribute, but these are, let's say you have a 10-year bond that was issued 2 years ago. Okay, so will that be still be in the market? It's a 10-year bond issued 2 years ago, so it still has 8 years to go, so it's in the market. So that can be your proxy for the yield on an instrument that's maturing in 8 years. So you can use some select off-the-run issues. It reduces the maturity gaps, but you might still be missing some information. So again, you use some linear interpolation. And finally, rather than just picking a few off the run, you can use all your treasury coupons, securities and bills. So use all the treasuries out there. Okay, so the good thing is you'll get a ton of information, but the negative is that on some maturities, such as the 3-year maturity, there might be more than one yields. Why? Because let's say, actually, I don't think we need to get into details, but let's say that a certain kind of government security is allowed to be used as, the best quality collateral at banks. Okay, then what do you think will happen to the yield on those instruments? The price will be higher, the yield will be lower. So which one do you pick? Okay, and fortunately for us, even the curriculum says that this is a specialized advanced topic, so we don't need to get into it. Okay, so we will not. There is enough other stuff we need to do. But essentially, if you understand these 4 main bullet points and the sub-items, as far as a question that you might get on this, you're pretty much covered. So now we'll talk about what's called the swap curve, and sometimes this is also called the LIBOR curve. I'll just make a few points and then zero in on this. In the US, the treasury spot rate is commonly used. Okay, so when we want to talk about the term structure of interest rates, the one fundamental question is which interest rates? Okay, what are the different kinds of interest rates out there? You can have the interest rates based on the government securities. You could also have the rates on, say, corporate bonds. You could have rates on the yields or the spot rates on the AAA rated bonds, on the BBB rated bonds. So the question is which one to use. And the answer is, in the US, what is used most often is the US Treasury spot rate. But in other parts of the world, obviously the US Treasury spot rate might not be used. And what's gaining popularity is something called the spot or the swap curve. So what is the swap curve? The swap rate curve is based on a series of fixed rate quotes on interest rate swaps. Okay, now just a quick point over here before I come back to this. You studied this in level 1 under derivatives. There was this reading on swaps, and the most basic kind of a swap was a plain vanilla interest rate swap where you have 2 parties. And just to refresh your memory, here is an example. Suppose that you have a swap that specifies that one party, so you have the swap, you had 2 counterparties here. One party does what? So you had a fixed pair, and then what was the other? The other was a floating. So the floating normally paid based on LIBOR. Okay, and when we talk about swaps, the most common floating rate is the 3-month LIBOR. So if I pay fixed and you pay floating, we might say that every quarter, every 3 months, you pay me, we set a notional principal of say 100 million, and on a quarterly basis you pay me LIBOR. So is your payment floating or fixed? Your payment is floating. If we say that the tenor of this swap is 7 years, and we say that you are paying me a floating rate every quarter, and I need to pay you a fixed rate. Okay. Now let's say we do the sorts of calculations we talked about in level 1, and in level 2 we'll see this in more detail. But the point is there'll be some fixed rate that I'll pay you, which in present value terms is equivalent to the floating rates that you are paying me. That fixed rate that I pay you, if for example that fixed rate is 6%, that 6% is called a swap rate. Okay. Now will the swap rate for a 7-year swap be the same as the swap rate for a 2-year swap? Not necessarily. So for swaps of different maturity, the swap rate will be different. And if we take something like this, an example from the curriculum, if we take different maturities, take the 2-year maturity, what's the swap rate? It's 4.2. Then you take the 6-year, there the swap rate is 5.7. In the 7-year it is 6. So when you plot these points, which give you the maturity of different swaps and the fixed rate, which is the swap rate, then what do you get? What's this thing called? This is the swap curve. And why is the swap curve often called the LIBOR curve? Because mostly the variable rate or the floating rate is the 3-month LIBOR. In Pakistan, what would the variable rate be? It would be KIBOR. Okay, so can we create a swap rate curve based on KIBOR? We could. So it's one of the most, of all the derivatives that you will talk about in this class, the one that is most common in Pakistan is a plain vanilla interest rate swap. Okay, now what is a swap spread? A swap spread is equal to, remember what a spread is? It's the difference in the yield between two bonds. Okay, now in our example, the swap rate was 6%. So the swap rate would be, the swap spread would be the swap rate minus the government yield on a bond with the same maturity as the swap. So in our example, the 6% was on a 7-year swap. So we figure out what's the yield on a bond with the same maturity of 7 years. Will the yield on the bond be more than 6%, less than 6%? It will always be less because the government yield is considered, the government bond is considered default risk-free. So obviously the yield on any other instrument is going to be higher. Okay, so the example is a hypothetical 7-year swap. Let's consider that. Suppose that the currency of the swap is US dollars and the estimated 7-year US Treasury yield is 5.4%. And since the swap for our 7-year instrument is 6%, the swap spread is equal to 6% minus 5.4%, which is 0.6%, which is 60 basis points. So that's the swap spread. Now, what does the 60 basis points represent? Okay, the swap spread represents the credit risk of the banking sector in a country. Okay, why do we say this? Take what does KIBOR stand for? It's the Karachi Interbank Offer Rate. It's the rate at which large banks lend to each other. Now, when large banks lend to each other, is there any credit risk or default risk? There is not much, but there is a small amount. So there is a small credit risk. That credit risk is the swap spread. Okay, so if the swap has been created based on KIBOR, then, and if we compare that swap fixed rate with the government bond rate, the difference is called the swap spread, and that spread represents the credit risk of the banking sector in our country, and obviously the same logic applies in any country. Okay, so not a very difficult concept, but an important one. Okay, now what I mentioned earlier, that the swap rate curve is becoming increasingly popular. There are 4 basic reasons. I just took out the entire segment from the curriculum, but I'll make you remember the core point here. You need to remember that there are 4 reasons why the swap rate curve is becoming popular around the world. The first is just basic. There is almost no government regulation in the swap market, okay, in general. So we are being told this, this might not be 100% true in Pakistan, but in general, there isn't much government regulation. The point is this: do you think the government bond rates, they might be impacted by the different government regulations in different countries, but the swap market is not generally regulated. So it is easier to compare the swap spreads across different countries than it is to relative to comparing the government the yield curves based on government bonds. So that's the first point. There is almost no government regulation of the swap market. The lack of government regulation makes swap rates across different markets more comparable. So that's the core point number one. Point number two is the supply of swaps depends only on the number of counterparties that are seeking or willing to enter into a swap transaction at any given time. Since there is no underlying government bond, there can be no effect of market technical factors that may result in the yield of a government bond issue being less than its true yield. The point is this, an example I gave you earlier, in a lot of countries, especially in the banking sector, government securities represent an important form of collateral. Also, if a bank holds government securities, then what's called the capital requirements of a bank become less. So effectively, banks are encouraged to keep certain kinds of government securities. So if the banking sector is being encouraged to keep certain government securities, what happens to the price of those securities? It becomes higher, so the yield becomes lower. So is that a problem? It's a bit of a problem. That problem is there in the government sector securities, but not there in a swap market. Okay, next, comparison across countries of government yield curves is difficult because of the differences in sovereign credit risk. So is there more sovereign credit risk in Pakistan than there is in, say, just pick another developing country like, say, Malaysia? Probably. So again, comparing government yield curves is an issue. And finally, there are more maturity points available in a swap curve than in the government bond yield curve. So not a very difficult point. For you to memorize this stuff, as a point that I'll keep making over and over, it's hard to memorize the 60 pages, 80 pages of this reading, but you should know the summaries very well. So what I just described, this is the single paragraph from the summary that basically is telling you what you need to know. The advantages of using a swap curve as the benchmark interest rate rather than a government bond yield curve are, number one, there is almost no government regulation of the swap market, making swap rates across different markets more comparable. This is much easier to remember than the long-winded explanation on the previous page. So know this as point number one. Point number two, the supply of swaps depends only on the number of counterparties that are seeking or willing to enter into a swap transaction at any given time. Number three, comparison across countries of government yield curves is difficult because of the differences in sovereign credit risk. And number four, there are more maturity points available to construct a swap curve than a government bond yield curve. Okay, with government bonds, there'll be 6 months, 1 year, 3 years, and so on. But with the swap market, you can find many more maturities. Can you construct, if you have a swap yield curve, can you go from a swap yield curve to a spot rate curve? Yeah, so how would you go from the yields to the spots? Yeah, bootstrapping. Okay, same procedure. Given what I just described, the swap curve that I just talked about, would that be a yield or would they be spot rates? They would be a yield. What did when I talked about a 7-year swap? Okay, what happens in a 7-year swap that I just talked about? What's the reference rate? It was a 3-month LIBOR. So how often are cash payments happening? When is the settlement happening? Every 3 months. So with most swaps, the settlement happens every 3 months. So there are intermediate cash flows. So the swap curve is really analogous to a yield curve. Now, from that yield curve, if we want to construct a spot rate curve, you use the same bootstrapping process that we learned in level 1. Just the way you go from a government yield curve to a government treasury spot rate curve, similarly you can go from a swap yield curve to a swap spot curve. Same procedure. I think as long as you know that the same procedure called bootstrapping exists, that's good enough. I really doubt that you'll be asked to actually do the bootstrapping. Okay. Next, let's talk about expectations theories. Do you remember what this expectations, what these theories were all about? So these were theories that try to explain the shape of the yield curves. So expectation theories of the term structure of interest rates. Okay, now if you recall, we have studied three kinds of three theories, and I'll refresh your memory here. We are going to refresh our memory on the three theories and then get a little deeper. One was the pure expectations theory. We studied that. Then we studied this liquidity theory or liquidity preference theory. And three was a preferred habitat theory. So those were the three theories. We are now just going to get a little deeper. I've taken these points from the summary, so I'll just read this. The three forms of the expectations theory. Number one is the pure expectations theory. Number two, liquidity preference theory. And three, the preferred habitat theory. Assume that the forward rates in the current long-term bonds are closely related to the market's expectations about future short-term rates. Okay, now let's get into this a little more. Let's first talk about the pure expectations theory. At a very basic level, what pure expectations theory says is that the yield on long-term bonds is based on our expectations about interest rates in the future. Okay, now do you remember this thing called the forward rate? What's the forward rate? It's the forward rate. For example, if I say what is 6-month CIBOR going to be in January 2013? That is a forward rate. Okay, now let me just say a few more things and tie this together. Okay, I'll come back to these sub-bullets. Okay, so the pure expectations theory, this is the most basic one, postulates that no systematic factors other than expected future short-term rates affect forward rates. So what this is saying is that essentially there is no difference between expected future short-term rates and forward rates. Let's draw a distinction between these two. When we say forward rate, is that a contractual rate? Do you remember forwards and futures from level 1? And do you remember this concept of a forward rate agreement? So it is possible that we go to Standard Chartered Bank and say to them that I want to borrow 100 million for 6 months after 2 years. Will Standard Chartered give you a rate? Yeah, a rate that they are contractually bound to offer? That rate, so they will do that, and that rate is called what? That is the forward rate. So just keep in mind, whenever we say forward rate, we are referring to a rate that is actually contractually agreed upon between two parties. Now, is the forward rate, let's say that this is the 6-month forward rate 2 years from today. Is the 6 month, so let me just draw this out. So this is time 0. So this is time 2. And this is your 6-month period. So the forward rate is the contractual rate that you will be able to borrow 100 million for these 6 months. Is this the same as your expectation or your expected rate in the future? Okay, maybe not. Okay, but do you understand the difference between the two? An economist might be sitting over here at time 0 and saying that I think that the rate, 6-month interest rate 2 years from today would be 14%. These numbers will always be stated in an annualized form. Okay, now Standard Chartered, is there a guarantee that Standard Chartered will say, okay, if you borrow 6 months, for 6 months, after 2 years, I'll give you 14%? Not necessarily. Okay, now these different theories actually essentially give their opinion on this. According to the pure expectations theory, the forward rate and the expected future rate is the same, according to the pure expectations theory. So now listen to this carefully. The pure expectations theory postulates that no systematic factors other than expected future short-term rates affect forward rates. Okay, another way of putting it is, if Standard Chartered says that they can lend us this money for 6 months at 14%, then according to the pure expectations theory, the most likely interest rate at this stage for 6 months will be the 14%. That's the pure expectations theory. Because forward rates are not perfect predictors of future interest rates, the pure expectations theory neglects the risks such as interest rate risk and reinvestment risk associated with investing in treasury securities. When you invest in a long-term treasury security, are you taking any risk? They are called risk-free, but does that mean they are really risk-free? You are taking interest rate risk. So when we, just as a side remark, why are they called risk-free? They are really default risk-free, but it's a bit of a misnomer because there is interest rate risk. So the pure expectations theory ignores that interest rate risk. If you recall from the previous slide, the pure expectations theory has two interpretations. One is called this broadest possible interpretation and the other is a local interpretation. Up till now, I hope everybody is with me in terms of the basic concept of the pure expectation theory. Now we are going to understand this broadest interpretation and the local interpretation. So the broadest interpretation of the pure expectation theory suggests that investors expect the return of any investment horizon to be the same regardless of the maturity strategy selected. So effectively, what this theory is saying is that, let's say that if you are at time 0, you invest in a 1-year security, sell it, and then again invest in a 1-year security, your expected return is the same as investing in a 2-year security at time 0. So according to the pure expectations theory, the expected return is the same in both scenarios. Okay, just even if you go to a 20-year horizon, according to the broadest interpretation of the pure expectation theory, if you either buy a 20-year bond or you actually buy a bond, 1-year bond, and then roll over to another 1-year bond 20 times, according to the broadest interpretation, your expected return is the same. Do you think that in reality the expected return will be the same? Probably not. Where do you think you should have a higher return? So if one option is to invest here, sell and then reinvest, versus the other option is to go straight for a 2-year, where do you think your return should be more? It should be more in the second, and I'm going to get to that. But right now you just need to understand the different theories and what they say. Okay, so the pure expectation theory, the broadest interpretation is that it doesn't matter how often you buy and sell, as long as you are investing for 2 years, return is the same. The next version, which is also within pure expectations, the local expectations form of the pure expectation theory suggests that the return will be the same over a short-term investment horizon starting today, and the short term is generally up to 6 months or so. So will be the same over a short-term investment horizon starting today, and it is this narrow interpretation that economists have demonstrated is the only interpretation that can be sustained in equilibrium. What this point is saying is that, let's say you have two strategies. One is investing in a 20-year bond, and the other is investing in a 5-year bond, and then after 5 years you plan to sell this and invest in a 15-year bond. According to the local expectations, that at least in the short term, whether you go for the 20-year bond or whether you go for this strategy, according to this theory, in the short run, both will give you the same return. Again, whether you agree with this or don't agree with this is a separate point. All you need to know right now is this is what is being stated according to what? Yeah, according to the local expectations flavor of the pure expectations theory. Okay, so now getting deeper, we are still on pure expectations. There are two interpretations of forward rates based on arbitrage arguments. And what are these two? One is saying that forward rates are the same as break-even rates, and the other is that forward rates are the rates that can be locked in. What do we mean by break-even rates? So what this means is, a break-even means that this concept of forward rate is that, let's say that you have two options. One is to invest in a 6-month bond and then sell that 6-month bond and invest in another 6-month bond. This is the same according to the break even as going straight away for a 1-year bond. So either way, so the point is this forward rate, let's take a very simplistic example. Let's say that that your return on a 6-month bond is 5%. The return on a 1-year bond is 7%, then the forward rate is that rate which will make you break even regardless of which strategy you will use. So what's the approximate forward rate here? It's going to be approximately, if this is 5, this is 7, how much is this probably going to be? Approximately 9%. So the forward rate is that rate which will make you break even between these two strategies. So that's the break even interpretation. The other interpretation is this forward rate is the rate that you can lock in. So if you go to Standard Chartered and say that you are going to borrow money for 6 months, after 6 months, is that a rate that you are locking in? So that effectively is a rate. So both those interpretations those are the two possible interpretations of forward rates, or those are two possible interpretations. There can be others. Okay, the question is to talk about the break even first. So let me do it this way. This is straight out of level 1. Okay, let me just make you do a question here. So let's say you have a situation like this. You have so 0 to 6 months, or let me just actually work in years. So this is time 0, time 1, time 2. Let's say that the 1-year spot rate is 6% and the 2-year spot rate, let's say, is 7%. I'm just making up an example here. 2-year spot rate is 7%. Then the question is, what's your forward rate over here? The forward rate is that rate which will make you break even regardless of which strategy you use. So you can use two possible strategies. One is to invest 100 over here for 1 year at 6%, and then whatever you get, you invest at this forward rate for the second year. That's one strategy. Another strategy is that you take 100 and lock it in for 2 years at 7%. So the forward rate is that rate which will make you break even or give you the same return across these two strategies. And if you do the math, this will be approximately 8%. Okay, that's a linear approximation. You can, how would you do this precisely? Just to check your, the precise method would be 1.07 squared is equal to 1.06 multiplied by 1 plus whatever that x is, and you will solve for x. Okay, that's the more precise. Even if these rates are stated on a bond discount yield, bond equivalent yield basis, then you would break it up into 6 months, but that's not the point right now. Okay, so we've covered the first point. Advocates of the pure expectations theory argue that forward rates are the market's consensus estimates of future interest rates. Does this statement make sense? So if you believe in the pure expectations theory and you are told that the forward rate, so let's say the 6-month interest rate after 2 years is 14%, then you will say that if you believe in this theory, then you are saying that the expected rates in the future are 14%. Okay, forward rates have not been found to be good predictors of future interest rates. However, an understanding of forward rates is still extremely important because of their role as break-even rates and the rates that can be locked in. So we've talked about this. Another core point is that the other two theories that we talk about, they start with the fact that they use the pure expectations theory as a base. Okay, so let me just remind you of something from level 1. We are going to talk about the liquidity preference theory. So do you remember this picture? If you have a yield curve that looks like this is maturity and this is yield. According to this yield curve, assuming that you believe in the pure expectations theory, okay, what is this saying about interest rates in the future? Yeah, so this is the assumption, or what this is telling us is that interest rates in the future, or the forward rates, are higher, which is why the yield on longer term maturities is higher. Okay, now people who subscribe to the liquidity preference theory say that to convince an investor to hold, say, a 20-year bond, the person who is holding or investing in a 20-year bond, is he going to take on more risk? What risk is he taking on? He's taking on interest rate risk, because the chances that the price of a 20-year bond fluctuate, obviously when interest rates change, the price of a 20-year bond will change much more. Okay, so he is taking on some extra risk. So for taking on some extra risk, should there be a return premium? That premium, for some strange reason, is called a liquidity premium. Okay, even the curriculum, I almost find this a bit of a misnomer, because this premium has nothing to do with liquidity, because even if the 20-year bond is just as liquid, it might not be, but theoretically if it's as liquid as a 6-month treasury, then it's not really a liquidity premium, it's a premium because of the extra interest rate risk. So people who subscribe to the liquidity preference theory say that the yield on longer term bonds will be a little more. And where is this little more coming from? It's the extra risk associated with investing in a longer term bond. Okay, so do you think the liquidity preference theory also needs to worry about expectations about interest rates in the future? Obviously. Do they need to worry about the forward rates? Yeah, it needs to, because this liquidity, this premium is built on top of what? Actually, the way you think about it is, what this theory says is that if you look at, say, the forward rates, will the forward rates have this premium built in them or not? Yeah, now you have to think, this is very subtle. The forward rates have the premium built in them. Okay, so the way you can think about this is, let's say that you are an expert on our economy and you have a very good, and you and all your economist friends expect that interest rates after 2 years are going to be 13%. Let's say, so this is your expectation about interest rates in the future. Now, if we believe in the liquidity preference theory, will the forward rate be 13%, more than 13%, or less than 13%? Harun? It will more than. So the point is, the forward rate will be more than 13% if you believe in the liquidity preference theory, because we are saying that there is going to be a premium built in. Okay, so that's the point. Okay, so that's your liquidity preference theory. The liquidity preference theory states that investors will hold longer term maturities only if they are offered a risk premium, and therefore forward rates should reflect both interest rate expectations and the this liquidity should be in quotes. I don't know where that term comes from, but it's called the liquidity risk premium. So that's what we'll call it. Okay. If you read the curriculum carefully enough, even they comment on this. Okay, so that's our liquidity preference theory, and what you need to do is just memorize these statements from the summary. And finally, the preferred habitat theory, this was our third theory. The way you can think of it is our base case is pure expectations theory. The liquidity theory just builds on top of that and says that there should be a premium for the extra risk associated with longer term bonds. So that's our liquidity risk premium. And then on top of that, according to the preferred habitat theory, what this says is that in addition to what we've already talked about, there might be a different demand supply scenario in different maturity buckets. The point being this: let's say that in a given market, there is a big demand for 20-year bonds, because most of the pension funds have liabilities that will come due in 20 years. So if you are a pension fund with liabilities coming due in 20 years, then would you not have a big interest in bonds that will mature in 20 years? Okay, so then if you have a high demand for those bonds, then the price of those bonds will go up and the yield will come down. So what this is saying is, in addition to the factors we've talked about, we also need to consider the supply and demand characteristics in various maturity buckets. Okay, and that essentially is what you need to know. So now if you come back and look at this picture, just as a quick summary, you've understood the base case, which is the pure expectations theory, okay, which simply looks at expectations about interest rates in the future. It has what's the broadest possible base interpretation, that whether you invest in a 20-year bond or you invest in a 1-year bond over and over for 20 years, expected return is the same. Okay, a slightly better form of that theory is a local expectations theory, which says that at least in the short run, the return will be the same. Then we go better and we talk about liquidity theory, which builds in the fact that we are going to get a premium for investing in longer term bonds because we are taking on more interest rate risk. And then the preferred habitat theory builds on top of that and says that we should also consider the supply and demand in different maturity buckets.